Hey, good afternoon, everyone. Marty Mazzora here with an early week update for you. It's Tuesday, the 28th of October, 2025, and I am actually going to keep this one quick. Just thought I would speak to the charts that I sent you yesterday about breadth. Today is no different, in fact, even more so in terms of bad breadth than yesterday. The chart in front of you, or not the chart, but the table in front of you shows you here, look at the Dow Jones Industrial Average as I speak, advanced decliners. 16 of the Dow 30 are down, 14 are up, but lo and behold, the Dow is up 190 points as I speak to you right now. The S&P 500, clean that up a little bit. S&P 500 is up 0.26%, 0.25, almost 400 of the S&P 500 stocks. 382 are down, 120 are up. There's a little more, by the way, 503 stocks in the mix. So over 70%, call it nearly 80% of the S&P 500 is in the red, even though the index is up today. The NASDAQ is up 82 basis points with 1,900 down and 1,000 stocks up. So, folks, again, this just screams about the concentration in this market, the likes of which we haven't seen since the tech bubble burst. Here's another screen for you. This one is the Bloomberg IMAP, and it breaks down sectors. So again, as you can see, 23%, so 77% of the S&P 500 is down, while the index itself is up 29 basis points. So where is it? It's all in technology, a little bit of consumer discretionary, and a little bit of materials. All the other sectors are in the red. Utilities by 1.6%, real estate by just over 2%, but energy is down 91 basis points. Even consumer staples, your big blue chip stocks, are down a little less than 1% on the day. In terms of our own measures, and these we update every week, the S&P 500 advanced decline line, this moves up or down based on the number of advancers versus decliners. Actually, yesterday, breadth actually got a little better later in the day yesterday. Still wasn't great, but you can see that it was a little better. Today, that thing is going to go straight down. The ones that have been really good tells for us that concern me more are like the percentage of S&P 500 companies that are trading below their 50-day moving average. So here's the S&P trading well above its 50-day moving average, which is the green line. And just a little more than a half, worse than that today, are trading above their 50-day moving average. Now, when I move this back a few years, and I'll go back to the tech bubble, you'll see why we track this. When the rally does not get confirmed by breadth, it's not unusual that we don't take some pretty decent drops. This doesn't look like much, but it was 16% in here. And you can see even before COVID's big drop, and certainly before the 30% decline in 2022, that these things do give us signs that the market's getting extended, or the index is getting extended while the rest of the market really isn't participating. So this is a very deep divergence here, and this is the one right before the 21% decline earlier this year. In relation to the 200-day moving average, slower, obviously, technical indicator. As you can see, the S&P is well above the blue line right there, hugely actually. Wow, 65% of the stocks are not. And you can see again these divergences. This one's a little easier to game here, and you can see the signals here where we had these bearish divergences right before we had the market give some back. So again, while I'm not really bearish between now and the end of the year, this is a signal that says that, we should be somewhat guarded with our expectations going forward. And then the one I always say is the scariest one I've ever seen is the advanced decline line for the NASDAQ Composite Index. This is just a massive bearish divergence as we continue to move into all-time highs. and it looks too much like it did back here and these other weak spots. So again, it does not mean, folks, that the rest of the group can't catch up to that concentrated bunch that are doing all the heavy lifting. That would be wonderful, and we would do well in that scenario. But history says do not at all bet the farm on that particular outcome. And there was the final bell. The S&P closed up 0.23%. The Dow was up 181 points, and the Nasdaq was up 0.75% when most of its stocks were actually down on the day. While I'm at it, I'll tell you what our core allocation did on the day. Essentially flat, up 0.02% to close the day. We were up most of the day. Gold was down 0.75%. Let's see, consumer staples have closed down over 1%, and that's our fourth largest individual position. It's about 6% of our overall portfolio. Industrials were actually down almost 0.75%. Small caps were down 0.5%. I'm giving you all the bad news first. Europe was down just a little bit, 0.15%. Financials, U.S. financials were down 0.33%. Ag commodities were down 0.5%. Utilities were down 1.65%. Energy down 1%. What really worked today was uranium miners. We were up 10% in our uranium exposure. We have a biotech company who actually added a little bit today. Today was up 1.6%. AT&T was up a little bit, and so forth. So, yeah, our portfolio balanced out pretty nicely today. Again, most stocks were down. We basically were flat, up 0.02% for what it's worth. The Fed meets today and tomorrow. Quarter point cut is discounted in. Let me show you that real quick. Essentially 100% odds of a rate cut tomorrow and 91% odds of another one in December, and then it starts going down as we get into next year. That's in the market. They are not going to disappoint, trust me. The question is, what will they do about quantitative tightening? And I mentioned this in the video the other day. A lot of people think that there's no way they would put a halt to the $40 billion a month that's rolling off of the Fed balance sheet. I'm not so sure. It depends. So we'll see what they do. If they did announce a halt to QT, I do think you would see quite the rally tomorrow. I don't know that the market's anticipating that. If it is and we don't get it, then you'd see the market sell off on that 25 basis point cut. It's not about the cut. It's about what Powell says in the press conference and how he answers the questions. It will determine, what the near-term reaction is going to be for the market. So stay tuned for that. Our PWA index is still flashing, a recession warning, although we're not getting a lot of data right now because of the government shutdown. As I mentioned the other day, we're beginning to rethink our view, at least going forward, about what the fiscal engine can bring to bear with the spending bill and running big deficits and the incentives to keep things alive in a midterm election year. However, some people who really track liquidity closely are actually suggesting that liquidity for the U.S. economy is going to tighten up next year, and that's going to be problematic for the market. So we have more work to do understanding that narrative. I get where they're coming from a potential monetary policy standpoint, because if we don't get a recession, we don't get any weakening in the economy, we don't get any weakening in inflation, and in fact, we don't get any help in the interest rate space when it comes to where we borrow on the long end, like for the mortgage. That's going to be more tied to the economy and inflation risk than it is what the Fed is doing. As I've made very, very clear and used as an example, September of last year when the Fed cut 0.5%, mortgage rates promptly went up 1 full percent because they were cutting into a scenario where the economy was plenty strong and inflation was a problem. Got to be very, very careful in those scenarios. I mentioned in the last video the Bank of England's experience when they tried to do that, which was a near-term disaster that could have been very systemically problematic were it not for what the Bank of England stepped in and did right at that time. That was kind of the narrative that being policymakers stepping into problems quickly these days. That was the message that I sent you in Saturday's video. So if you didn't get a chance to watch that, I highly encourage you to. So folks, in a nutshell, breadth is bad right now. Market could get very happy tomorrow based on what the Fed delivers. If it doesn't deliver what the market wants at these levels, look for a pretty good sell-off. I'd probably favor the former, but we're definitely not positioning for that or not making a big bet that that's what's going to happen, because we do think that when you look at valuations, short term, you look at breadth and sentiment, the market's definitely exposed here, notwithstanding the seasonality going forward, which historically is very, very good. So, on balance, if I backed into a corner, I'd say, yeah, we probably close the year higher than we do right now. But there's enough out there that could make that a bad call. It's going into next year. It's going to be very interesting, and where we're really going to have to stay on our toes and continue to be very tactical as we have been of late. Folks, thank you as always for watching and listening. I'll be back at the end of the week with something a bit more robust. Hope you have a great day. Take care. Bye-bye.